Good morning and welcome to those of you who were with us last week. Welcome to all of those of you who are with us this week. Good morning all. Welcome to those of you who joined us last week and welcome to all of you who are new to us this week. My name is Dan Nolan. I have the privilege of serving as president of Hugh Johnson Advisors. We're a financial planning and asset management firm. And I'd like to thank the Times Union, our partner in these back to business and restarting the economy sessions. Let me tell you what we're doing and why we're doing it. Lots of information that we get every day about COVID virus, about the medical information, and some information about restarting the economy, but more about when we're going to restart. There's no playbook and there's no one glide path for restarting our businesses. And we thought that a community discussion of business operators, business owners, to perhaps talk about some of the challenges and maybe offer some solutions would be a really useful community discussion. Last week, we talked about workplace challenges and safety in the workplace. And this week, we're going to talk about a very serious topic. Lots of ingredients to a successful business, but you cannot have a successful business without one key ingredient, and that is capital. Working capital, capital for growth. You cannot starve the business of capital. And here we sit in a time when there's a shortage of capital, or at least in many cases, a delay of getting access to capital. So we have a panel of expert professionals who are going to discuss those issues. Before we do that, we thought we would start this week the same way we started last week, which is a couple of minutes of Hugh Johnson, who, as you all know, is a local economist who studies business and economic cycles, and who's studying this cycle very carefully. And he's going to talk to us about what he sees today for the restarting of the economy. So I'd like to introduce my partner, the chairman and the chief investment officer of Hugh Johnson Advisors, Hugh Johnson.
Yeah, thanks, Dan. Nice introduction. Thank you, everybody. Panelists, Times Union. I can't tell you, folks at the Times Union, how much we appreciate the partnership in getting this very important job done for the local community. And thank you, all the panelists. You know, my role today is very similar to my role last week, which is to give you a little bit of a sense of what's going on in this world of ours, sort of the context within which we're going to be trying to reopen all our businesses and do well, or at least survive. Let me just start by giving you a little bit of a sense as to what's going on in the economy. There's bad news and not so bad news. What I've done in order to try to give us an idea what might be transpiring over the course of the remainder of 2020, 21, and 22 is I've taken a look at just about every bear market since 1890, every bear market that's been accompanied by an economic recession. And of course, we're in an economic recession right now. So I've done that, looked very hard at them all, look at every pandemic, look at every epidemic, and try to learn what's common among them where we can learn some lessons which might be useful this time. And the one thing that I mentioned last week, which I think is also important to sort of restate, and that is there's only one thing that they all have in common. And I think it's important just to note it, and that's as they all end. Other than that, they don't have anything in common, but they do all end, and this one's going to end just like every other one. And I'm going to try to give you a little bit of a sense as to what I think, how this one's going to play out, or how this one might end. I'm going to try to tell you a little bit about what I think lies ahead for the economy, and also important components of the economy, such as employment, inflation, and what's dear to the hearts of almost everybody is stock prices. To do this, I've looked at the consensus forecast for the economy for 2020, 21, and 22 from the 38 leading economists in this country. I've tried to establish what the consensus is, and we'll call that our base case. I've also looked at the average of the worst to the lowest of forecasts. We'll call that the worst case. And I'll mention a little bit about the base case and a little bit about the worst case, just to give you a little sense of how bad things could possibly get. This is very interesting. There's, as I mentioned, some bad news and some not so bad news. The bad news is really when we take a look at, first of all, the first quarter where we had the start of a recession, 4.8% decline, a contraction in the US economy. I think it's interesting to note that none of that really occurred in the months of January and February. It all occurred in the month of March. Well, what's going to happen now is we're going to take a look starting this Friday with the employment data for the month of April. We're going to look at April, and you're going to see that what happened in March continued in April. And quite frankly, it's going to make for some fairly gloomy, dismal reading. The numbers you're going to see on employment, for example, for the month of April, you might see a loss of between 17 million and 20 million folks that have lost their jobs during the month of April alone. And the unemployment rate might register or post an increase from 4.4%, which was the March number, up to as much as 15 to 20%. So April's going to be very dismal. What's interesting to me is that most of the decline or contraction that we're going to see in the economy this year and in the second quarter is going to occur, first of all, March, but also in April. Because when we get past April, when we get into May and June, we're going to start the process in a staggered way of starting to reopen the economy. So you're going to start to get some better news on the amount of business activity and also the employment numbers. I think you're going to be a little bit surprised. First of all, the second quarter, the one we're in now, most of it April, a decline or contraction in the economy is about 25%. Some very sensible forecasts from very sensible economists think the contraction could be as much as 40% in the second quarter. That by far is going to be the largest contraction we've had in our economic history, and we started the records on quarterly numbers in 1947. The second place goes to the first quarter of 1958, which was down 10%. So minus 25% or as high as minus 40% is a big number. But when we get to the third and fourth quarters, when we start to reopen, when we start to get better numbers on both output as well as employment, you're going to see positive GDP numbers, which is our kind of scoreboard. What you're going to see is something in the order of, say 7.4% third quarter, 7.9% fourth quarter. And as we move through 2021, in my judgment, we're going to see ongoing positive numbers as the economy struggles to recover from this really serious recession. Most of it, again, first quarter and the second quarter, 4.9% 2021, 2.6% 2022. So we're going to be in the process of recovering. Despite that fact, 2020 is going to go down in history as the fifth worst recession or year that we've had in our economic history, fifth worst behind 1930, 31, 32, and 1946. And employment, we're going to still, even though we'll have some recovery in jobs, will still be a big negative, something in the order of minus 8 million jobs lost during the year. So this is not going to be a good year. It's not going to end up as a good year, but keep in mind, we're going to be in the process of recovering third, fourth quarter and through 2021. I'm often asked the question, what about inflation? Everybody's very worried about inflation because obviously the federal government, both the Federal Reserve as well as the federal government in Washington, have been adding a lot of liquidity or money to the financial system. A lot of folks in their common sense belief is that that's got to lead to higher inflation. That is not the risk. The risk is not inflation, the risk is deflation. So you're likely to see the rate of inflation come down and come down seriously in 2020, 21, and 22. What I'm talking about is the rate of inflation now is around 2%. We might come down to about 1.2% in 2020 and maybe 1.5% in 2021 as the economy has been in the process of expanding. One other thing which I want to mention is that this is not just the national economy that's going to be hit or hurt by this whole process. We're also going to see the state economy and the local economy affected. The state economy, we could lose as many in 2020 as 500,000 jobs. I would put it between 400 and 500,000 jobs. And for the local economy, the Albany economy, we're probably looking at somewhere between, say, 11,000 and 13,000 jobs. But again, keep in mind, we'll be making up some of those jobs as we move through the latter part of 2020 and all of 2021. One thing that I'm often asked is how do you reconcile the fact that the stock market has been doing a little bit better more recently, and the economic numbers have not been particularly good? I think it's important to keep in mind that the stock market always is looking ahead. And basically, the stock market is looking well beyond this current quarter, the second quarter, towards the third and the fourth quarter and 2021, and sees fairly good prospects ahead for the economy and, most importantly, earnings as we slowly emerge from this really difficult period, and again, primarily focused on the second quarter. If somebody wanted me to sort of put numbers there, I would say the stock market is probably not reached its low yet. We may be in the process of moving towards that low. If I were to put some numbers to it, I would say, using the base case forecast, we're probably 9% above what I think is going to be the low. That might be in the third quarter. On a worst case basis, we're probably 16 to 17% above the low, which I think will be in the first quarter of 2021. So we're not a long ways away from what I would take to be the low for the current bear market. Keep in mind, bear markets, the average decline in bear markets is 38%. This one's already been down 35%. So I think most of the severity is behind us. What's not behind us is duration. So we're likely to have a period here of sort of a trendless and volatile market. In summary, let me just sort of summarize by saying this. You're going to be looking at some numbers that are really dismal numbers. They're dismal numbers for the second quarter. We're going to be in the process of reopening this economy as we move through May, June, July. It's going to be on a staggered basis. You're likely to see the manufacturing sector of the economy get back to work fairly quickly. The services sector, and that includes everything you've been reading about, is going to be slow to recover. Household balance sheets have been very seriously damaged during the recession, during this period of time, and household confidence or consumer confidence has also been damaged. All of that will come back slowly, but it will come back. And I think that's important to keep in mind. So when asked, is this going to be a W, a V, a U-shaped recovery? I would say it's going to be U-shaped. But keep in mind the most important thing I said, and that is every one of these pandemics, bear market-driven pandemics and epidemics ends, and this one's going to end. And I think it's going to end reasonably soon, but it'll be a long time, a long process of recovering. And I think that's kind of the environment, the economic and financial market environment that we're looking at as we look ahead towards the remainder of 2020, 21, and 22. I'm basically fairly optimistic about what lies ahead.
Thank you, Hugh. And as you can tell from Hugh's remarks, there is no glide path for what we're facing here. We've had other pandemics and we've had other bear markets. But I will say, for some shameless self-promotion, Hugh does a pretty good job at exercising judgment, at looking at business cycles. And although we don't know what's going to happen tomorrow or next month or next year in the market or the economy, I think what Hugh presents is a pretty sensible outlook. So thank you, Hugh. Really appreciate it.
You're welcome.
And if I might, I also mentioned up front that the Times Union was our partner in these sessions. And it's my pleasure to introduce the editor of the Times Union, Casey Seiler. And Casey will introduce our panelists and we will get our panel discussion going. Thank you. And Casey.
Dan, thanks a lot. And thanks very much to Hugh for that sobering and clear-eyed analysis. And with that, it's great to have everyone on the call, and it's great to be joined by this terrific panel. And I'll introduce them now. We have Ray Archibold, the managing director of Schwartz Heslin Group Incorporated. Ray has been with the firm since 2010 and currently heads its investment banking division. We also have Heidi Knoblauch, who is the venture and growth banking relationship manager at Pioneer Bank right here in the Capital Region. She is also the owner of Plumb Oyster Bar in Troy, where she is joining us today. And last but certainly not least, Pat MacKrell, the president and CEO of Pursuit, until March known as the New York Business Development Corporation. Pursuit is a non-bank lender that is owned and supported by the banks to facilitate lending to those who might not otherwise qualify. And I'd like to thank you all for joining us. I would also like to invite Dan to chime in as he sees fit. And I would like to encourage our audience listening in today, if you have questions that rise up over the course of this discussion, please post them. We are streaming both on YouTube and Facebook. Our folks are monitoring those questions, so please write them in, and we're going to get to them in the final act, as it were, of our discussion. So with that, let's jump in with our first topic. Let's define the scope of the problem for businesses that are seeking capital, whether from commercial banks or from investors. And how does the problem shift depending upon the size of a business? And I might throw that one to Pat MacKrell first to start us off.
Hey, good morning. Good morning, everybody, and thanks for joining us. The scope of that particular problem is as we pointed out, varies from size of the business and how you've reacted historically to the business environment. My expertise is with the smaller businesses that tend to have more volatile income statements, that tend to have weaker balance sheets. And those businesses have, over the last 6 weeks, 5 weeks, have dug into that balance sheet and used those funds to keep things going, like health insurance, utilities, rent, struggling to keep employees employed in some meaningful way. So how they access that capital going forward, the biggest challenge really is what is their business? Are they spending this time simply looking to restart what was, or are they using this time to think about what needs to be in order to be successful going forward? And that sort of has two stages. I mean, the first stage is, how do I organize my business and generate revenue in the absence of an effective therapeutic/vaccine, which may be the next 6 to 8 months? And how do I organize my business and operate it in the presence of an effective therapeutic and the presence of an effective vaccine, all of which will drive human behavior very differently? But what I will look at, certainly as a banker and as somebody to provide that, I'm going to look at how historically the business has managed difficulty. I'm going to look at strength of management, experience, the willingness to be flexible and resilient. And that challenge in terms of structuring that business going forward is going to be huge. Every business has a different cash cycle. I mean, our retail folks are going to be able to generate cash on day one. Our service folks are looking at, a cash cycle that may be 30, 45, 60 days and maybe more extended due to difficulty in collecting those receivables. So every business is going to have unique problems, and they're going to be required. At the end of the day, what's going to happen is the effectiveness of historic management. Historic revenue may not be as relevant to future revenue, but what will be relevant is how the management has responded to difficulties in the past and their strength and experience in the business.
Heidi, you maintain, it's right there in your title, maintaining these relationships. What are you hearing from businesses large and small in your capacity at Pioneer Bank?
Yeah, I think that I would absolutely agree with Pat. I think what the difference between a business that's going to be successful and not is really the leadership. And so leaders that we see in management who are taking this crisis as an opportunity, I think that's where we really are seeing a lot of strength shine through. We're still having deals go through at Pioneer Bank. We're still supporting businesses that are in need of capital now, whether it is from the PPP loans that everyone's been talking about or more traditional financing. But I will say, I just want to add to Pat, I do think that there's going to be opportunities still for businesses to start. So in my role at Pioneer in venture and growth banking, I deal with a lot of people who are starting up businesses. And I just want to encourage businesses that there are a lot of great businesses that have started in recessions, and that this is not a time to necessarily shrink away from that. There's wonderful opportunities in the capital region. I mean, ranging from local programs like the Alltech Fund at the Chamber to state programs to federal programs like SBA 7A loans that Pat can probably even talk more eloquently about than I can. And so I would just encourage people, in addition to maintaining and pivoting your business during this time, is that if you are thinking about starting a business, it's not, there's still capital for that out there.
Heidi, can I ask you a question? In your experience at the bank, they're generally pretty standard principles on which you loan money. And so let's say you have a smaller company, you loan against inventory and receivables. If the balance sheet is deteriorating and the receivables are falling, how do you respond to that?
So not without speaking about any specific client, obviously, right now there are lots of different options for people that are federal programs. So we're pointing them to sources that are that you have federally backed programs for. So the PPP is obviously the one that's been in the news a lot right now, but there's also the Main Street Lending Program that we're looking into and other things like that. So if someone's if the traditional indicators that we would use for financing are deteriorating, I mean, that as a bank, as a traditional lender, that is going to be tough. But my philosophy is that your bank is your partner and they should never turn you away, right? So there are tons of sources for capital and your bank should know about those sources and be able to point you in the right direction.
Ray, from the investment community, what is the situation right now? What are you hearing from businesses about what they are needing?
Thank you, Casey. And also want to thank the Times Union and Hugh Johnson Advisors for hosting this and for allowing us to participate. I'm going to echo a lot of what Pat and Heidi had just shared in terms of from the business perspective. You know, some of this really is how am I going to reboot my business and take advantage of opportunities going forward, and how am I going to rethink? In terms of capital available outside of the bank channel, there are plenty of resources. Heidi touched on the idea that banks ought to know that, but the idea is that you mentioned, I think, Dan, about if your balance sheet has some deterioration and you have receivables that have been aged. You know, there are some non-bank availability for asset-based lending where you can perhaps monetize some of those assets, particularly receivables. That's often a popular one. To the extent that inventory still has some value, that's another asset that you can monetize, if you will, in terms of gaining capital. That would be outside the bank channel. Granted, that's going to be more expensive lending, but typically that will help get you over some working capital bumps, particularly in the startup phase. So that's something that businesses of all sizes ought to consider in terms of rethinking and rebooting their businesses, looking at not only their bank, but if the bank finds that, you know, they may have moved too far on the risk curve, considering some of these alternatives. And we've had a number of conversations with some of our clients along those lines in terms of looking for sources of capital, particularly asset-based capital outside the bank channel.
How do they access those, Ray? Do they have to come through an investment bank?
Well, we would love for them to come through us. But generally speaking, many of these asset-based lenders, they have their own marketing programs and, you know, they have their own outreach, but more often than not, they're going through their referral network. So it could be somebody like us. Pioneer Bank, I'm sure, has a number of connections with some asset-based lenders, your attorneys and your accountants. So basically, I would suggest look to your trusted advisors, your banker, your attorney, your accountant, and they often have connections to some of these non-bank alternatives for financing.
You know, there are in the upper scale, certainly the ABL area, the asset-based lenders have, you know, a really effective place, and I think Ray pointed that out. But what many of the small businesses will need, you know, in the space that we work in at Pursuit, they're going to need working capital, and it's not going to be working capital that will attract an ABL appetite. It's not. They're not going to be generating receivables. They're not going to be buying inventory. They are going to need it to to operate. As Heidi mentioned earlier, some of the SBA programs that allow you to access working capital with little or no collateral, which you may not be available at this point, and doing lending based simply on projections, you know, that may be the next stage, as Heidi pointed out. That may be the next stage for many of these small businesses to access the capital they need to sustain operations during a startup period.
Ray, we mentioned, we've talked about leadership and flexibility in terms of what businesses need to be able to display to investors or to commercial banks in order to secure that, you know, the funding that they need. What else would be on the list of things that a business needs to be able to show if it's going to a potential investor?
I think we've each kind of hit on that generally, in that they need to kind of rethink. So if you sell widgets, You can't just come out and say, well, I'm going to sell widgets again, and then use that as your plan. I think you really need to come up with a revised business plan, which takes into account a number of factors. One is, how are your end markets going to react? If you're in the restaurant business, are people going to be coming back to the restaurant? And if so, when? To Pat's question in terms of if there is or isn't a vaccine. If you're a manufacturer, what are your end markets looking at? So one is get an assessment. Who are your customers? And what are some expectations we ought to factor in terms of their returning back to the market? Second is also your resources. And in particular, today in this environment, you've probably learned to manage your staff differently than you would have ever imagined, 8 weeks ago. So now that you can use some remote tools to allow your staff to work from home. And that has a factor on your cost structure in terms of, maybe I don't need as much real estate as I had before. Maybe I can downsize that. So that needs to be factored in. And thirdly, I think is also, there are other opportunities, and I think Heidi talked about startups, but also if you are an existing business, large or small, there may be an opportunity now for you to expand into new markets, either through acquisitions, because some of your competitors may have been weakened, as well as finding new ways to make your business more resilient should a second wave or some other crisis unfold that puts your business back on its heels. So that needs to be factored into any business plan that you put together in terms of being able to access capital. So I think really rethinking, how am I going to do business differently, both in terms of my customers, my resources, and the markets that I want to address.
Heidi, are businesses doing that right now? We're about 2 months into this crisis. Are businesses, what kind of letter grade would you give in general to businesses that are coming forward seeking that capital? Do you hear those kind of reinvention plans that Ray is kind of describing?
So it's not necessarily, and I can also speak from my own experience as an entrepreneur, but what you'll see is that entrepreneurs are going to find ways to make money and survive. So true entrepreneurs, that's in their DNA. It's like, how do I pivot to figure out a way to make money? So I think that if I were to give a letter grade on the entrepreneurs in the Capital Region, it's an A+. We are a region that is full of fantastic entrepreneurs. And so I think that entrepreneurs are going to find a way in order to make money. Now, I think that there are some people that have taken the PPP loan, for instance, let's just say, because that's just an influx of capital onto Main Street right now. And they've tried to reopen business as usual, and they might have found that didn't work. So now they're going to have to start to pivot, right? So for me personally, we started with the easiest transition ever, right? So we said, okay, last Friday we opened for takeout. That's like a no-brainer, right? Like, that's not inventive in any way, but we just said, let's see how this goes for 2 or 3 weeks. I brought my staff back, and to be honest, it's going to be 8 weeks of figuring out how the staff react, how they can pivot, how we can pivot, and how we can make money. And I just want to give you a small example because it might help other people out there. And I know we'll get to a resources discussion, but I am definitely living with the harsh reality that I do not believe that people will come and enjoy Plumb Oyster Bar in the same capacity for another 20 to 24 months. So in dealing with that, I'm trying to think about different revenue streams. So when we opened for business, and I think this is a lot of how entrepreneurs think, we opened for business, people said, we want oysters, but I didn't have a good way to pre-shuck oysters and give it to them. So I looked up containers to do that. There just aren't really good options for containers to sell pre-shucked oysters. So I called the Tech Valley Center for Gravity, which is around the corner here in Troy, great little manufacturing center for those of you who don't know about it. And I said, hey, listen, I have this idea to make this oyster tray that we could use at Plumb and then maybe sell in the future. Can we do that? And they said, yeah, absolutely. We can send over a CAD file and we can print one out and we can just see how it goes. So then I called SBDC and I said, hey, listen, can I use your research library? Can you figure out for me what the end user would be of this type of product? So that's just a small example that happened in the last 3 days. But I will tell you that I bet that example is being replicated across entrepreneurs in the Capital Region.
Ray, what do you do if in the last year or so you've started a company and you're going through your typical series of, friends and family seed rounds, and then you expect to do a Series A, a Series B. What happens today to that company? Is that kind of capital available?
So Dan, thanks for asking that. Yes, that kind of capital is available. There's a lot of liquidity, both in terms of private lending sources and private equity sources, as well as venture capital for earlier stage companies. So the liquidity is there. I cannot tell you how many emails I get every day from these sources saying, hey, do you have a deal for me? But again, I'll turn back to my earlier comment. It's conditioned on that. How did you rethink your business, whether it be as the example that Heidi shared in terms of, hey, I got a new model or some other alteration in your business model, so that they gain comfort that there's going to be some progress going forward. Because we all recognize, at least for the foreseeable future, next 6 to 12 months, we're still going to be in a high risk environment from a business perspective until we kind of figure out how things are shaking out. So capital is available. It's available whether you're a manufacturer, in a service business, professional services, if you have a consumer facing business, that capital is available. It really comes down to what we've been talking about here. Management, the entrepreneur and the management, have they taken steps to modify or alter or pivot, whatever term you want to use, their business such that they have a way to react to and be proactive in this new environment?
I just want to pause to remind people that if they have any questions, we want to address as many of those as we can, and they can post them right on our Facebook page or on YouTube. This ought to be, and we hope it is, streaming on both of those platforms. I'd just like to point out that actually Heidi recommended swapping out what was going to be sort of our third broad topic. Initially, the question was going to be, what would the panel recommend the federal government do if it creates yet another future version of the PPP, essentially extending it? And Heidi said, I don't kind of care for that question because I don't think another round of PPP funding is likely to come. And she recommended that instead we pose the question, and we've touched on it a couple of times so far in the discussion, on what companies need to be doing with the PPP money that, if they're lucky enough to have already received it, that they've gotten. I think Heidi gave a wonderful example of that in talking about how companies can need to devote those resources, that capital, to innovation. What are some things that companies should not be doing with their PPP capital if they've got it right now? In other words, is it okay to use it kind of to keep employees whole or at least partially whole? Or are you failing if you are using that PPP money absent that sort of reinvestment plan? And maybe I'll pitch that back to Heidi again.
Yeah, sure. So the PPP guidance on forgiveness is still coming out, but the three big things that people have to hit are they have to spend 75% of the loan amount on eligible payroll costs. They have to maintain their headcount for FTEs, and they have to maintain wages. And we'll see how that guidance comes out. It might be that it's maintained wages for everyone, or it's maintained wages per employee. You can't drop them more than 25%. But so really working within those guidelines is important. But for me, employees are like a family in a restaurant. So very much like a family. And so what I'm doing is I'm giving each one of those members a shot. I'm saying, hey, listen, this is going to have to change. I want you to come back. I want you to work, and I want you to be here during this change. Those that either don't come back with full vigor, or those that are unable to pivot, that's going to be a tough challenge at the end of this 8-week period, because at the end of the 8-week period, that PPP money is no longer available to sustain kind of this. We basically get a moment where we can figure out what we're going to do next, and we get 8 weeks to do it. So employees are along for that ride, and customers are really going to determine what things people are going to do. So if people don't order takeout from Plumb Oyster Bar, we will not be doing takeout after 8 weeks. You know, that's that's just business, right? So I think 8 weeks is a good period of time to say like, hey, if we, we had an idea, we're gonna do an oyster shucking class online and give people washed oysters with an oyster knife and a towel, and we're gonna sell that and allow people to shuck oysters at home. If people buy that, we'll continue to do that. But if they don't buy that, we won't continue to do it. And so that's just business, right?
Everybody becomes an entrepreneur again.
Right. And I guess what I'm saying is even the employees. So Casey's question is what not to do with your PPP money. I would kind of throw that not necessarily on the owner of the business. I would throw that on employees. So what not to do with your employer's PPP money is squander that time where you can reinvent yourself at work.
Pat, do you want to add to that?
It's, in Heidi's business and some of the retail businesses, you can start at some level of operations, and that's terrific. And using the PPP for that is, it's very helpful. I mean, one of the difficulties with PPP is it was not regionally adjusted. Everyone has to use the money within that 8-week period following they're taking down the money. But if you happen to be a restaurant in Georgia, you can use that PPP money to staff up and generate revenue. Many of the businesses that received it aren't necessarily they're able to staff up, but they may not be able to generate revenue. And they may have financial support for payroll for 8 weeks, but at the end of that 8 weeks, they may not be able to generate revenue, and they're going to be taking an employee off unemployment, paying them for 8 weeks, not generating revenue, and then perhaps putting them back on unemployment. As I said before, that's great. Your unemployment is retroactive, but you can't eat retroactive, right? You can't take that to the grocery store and buy food with retroactive. And that's sort of unsettling. But, one of the things to pick up on what Heidi pointed, and I'm sometimes blunter in my language than others, but one of the things we found out in our business, and we've never stopped, and in fact, we've gone 24/7 actually with the banking side of the small business. But you have an opportunity to figure out who are your heroes and who are your zeros. And that is become, if you look at the people who've stepped up and said, what can I do to help? As opposed to the people say, well, I don't feel so good. And I'm gonna, I'm a little nervous, and not discounting that, but you find out who's got that soul that aligns with yours, who's got the energy and devotion, and it's going to be your partner and employee going forward to make your business successful. Because that's what it's going to take. It's going to take motivated, energized employees. And there's no better time to find out who they are than in times of crisis like this.
Ray, what's your firm saying to companies or communicating with companies about the best way to spend their PPP funds if they've got them, and perhaps the wrong ways?
So our clients, Casey, our clients probably skew on the larger side relative to what Pat and Heidi are referring to. And so for them, the PPP money has really been kind of an injection of additional working capital. Many of our customers are still generating revenues, albeit perhaps at lower levels, but they're still generating revenues. And that cash flow can be used for shoring up the balance sheet in other ways, paying down some debt perhaps, or using it to use Heidi's ideas as trying, sort of skunk works projects in terms of new investments and new opportunities. So it's given them a little bit more flexibility to use whatever cash flow has been coming in to, again, either shore up the balance sheet or invest in new opportunities. And we've tried to encourage that with our clients. We've had a number of interactions and mailings and conversation with our clients along those lines, is to use that money to take advantage of either opportunities for new products, new markets, restructuring the balance sheet if you had been a bit overextended coming into this, and also perhaps considering, are there opportunities where I can maybe make some acquisitions of some weakened competitors or enter new markets. So our clients probably have had a little bit more flexibility in terms of how to use those funds relative to what Pat and Heidi have experienced with their respective markets.
Ray, I was going to ask you a question. You just alluded to it, but are you seeing the strong picking up the weaker? Do you think there's going to be more activity and people, with strong balance sheets, hunting for weaker balance sheets that, could be bolt-on value for them? Are you seeing any of that, or do you anticipate that?
I think you're going to see a lot more thought on both sides of that equation. So yes, our stronger clients, I think, will be looking at opportunities. How do I take advantage of some weakened competitors or a highly fractured or highly disruptive market to enter into new marketplaces? Conversely, there are going to be some companies, even of the size that we deal with, where their owners, the entrepreneurs, the families may decide, this has just been too much for me, and I may have to start thinking about how do I exit my business. It may not happen today because of fear of selling into a depressed market, but I think you're going to see people perhaps rethinking their exit strategies given the turbulence that they've been experiencing over the last several weeks. So I think you're going to see more activity on both sides, and that's going to play out, I think, over the next several months.
Yeah.
So last question from me, and then we'll turn to some questions from the audience, I hope. We've mentioned a couple of them so far, but what are the resources or tools that businesses can tap that are not banks and not investors? In other words, not necessarily the capital sources, but the sources of information, of advice on how they can navigate this fiscal crisis and this health crisis as well. Heidi, I think you mentioned some regional offerings, but what others would you point out for those kind of taking notes at home or in the home office?
I mean, I think your first point of entry can be your chamber. So the Rensselaer County Chamber to the Capital Region Chamber can definitely be a good point of entry. I think you'll see more and more information coming out from our regional economic development centers. So watching for that. I think any association that someone is part of, so the New York Restaurant Association, I'm a part of it, and I go to every webinar, right? So if you're a part of an association, I think definitely getting that industry specific knowledge is important. For funding, I mean, I think going to Pursuit is always a fantastic option for people. They do a great job. I know they're very busy with the PPP loan, so I don't mean to put more on your plate, Pat, but you do a great job, sorry. And so I think Pursuit does a great job. I think the All Tech Fund is a really good source of funding. I think don't forget about your IDAs and your LDCs. So if you're, starting up an operation and you need some tax incentive money in order to get that started, I think your IDAs are great. Your LDCs, which is your local development corporation, those are great too. And then, on the state level, I imagine, I don't know this to be the case, but I imagine that the Downtown Revitalization Initiative probably won't happen this year, which is the grant of $10 million that are given to downtowns in New York. And so, but I do imagine that there will probably be incentives to kind of keep our main streets full. So if you have a retail outlet, I would look for what that money turns into. And then federally, I think your SBA programs. So the EDL, I know, just opened up the Economic Injury Disaster Loan, just opened up for agriculture yesterday. I think they're going to reopen another round is the impression that I got. And so I think looking to your SBA for funding is important.
And would anybody else add to that outstanding list of organizations or entities that can offer help at this time?
I think that, there are two aspects that you could also be utilizing in a very reasonable way. It's just as simply management by walking around. So you're taking, look around your neighborhood, look around your similar businesses. Maybe you take a trip to someplace that's opened up post-pandemic and see how they're managing, see how their customers are reacting. Try to get some real-time, intelligence in terms of, what is the best way to react, what is the best way to reopen, and what kind of customer, activity can you get, or what kind of customer attitudes you're going to be experiencing. I think also, Troy is a great place. Troy is, in terms of development, Troy has energized and had a renaissance in the last 5 or 6, maybe 7 years. That is amazing. So those merchants can rely upon themselves. They do a lot of things together in Troy, and that's been part of what there's been successful. But look to your neighbors, whether it's in your strip mall or your mall, or whether it's in your type of business, your neighborhood. Look to them and start to formulate organizations, plans, and strategies to create that rising tide that you need to all to be successful.
I would like to add to what Pat and Heidi have shared is that also look to your advisors. I know we've made ourselves available and had a number of conversations with clients where, our clients span a broad spectrum of size, industry, business models, and helping to share best practices that we have seen come out of that. I would also look to your accountants and your attorneys, because similarly, they are looking at a broad spectrum of businesses and clients, and they can help share best practices in terms of how people have adapted to this this environment more effectively or less effectively in terms of avoiding some pitfalls that some have experienced. And so I would say turn to your advisors as well, because they probably are bringing a broader perspective than what you have from your own direct experience.
Can I just add to that for one thing that certainly Holly mentioned in the beginning? The entrepreneurs have a phenomenal gut and instinct. Listen to that, right?
Yes.
Don't get crowded out with everybody who purports to be an expert about your business, your energy, your dream, your excitement. Listen to your inner being and let that sort of be your guidepost. Don't give up on yourself. In other words, just, your instincts were good before and they'll remain good both now and into the future as to how you adapt.
I would use this opportunity to make a programming note. Heidi mentioned the good work being done by the Restaurant Association. My colleague at the Times Union, Steve Barnes, is doing a Facebook Live at 1:00 today, talking to the head of the Restaurant Association. So I hope everybody who's on this call or many of them will check back in for that. And Heidi, you too. And with that, I'll hand it off to Dan, who hopefully has been getting some questions from our listeners to throw to the panel.
Yeah, lots of questions. In fact, Ray, this question hitchhikes on the answer you just gave, and it is, are there counselors or mentors available for entrepreneurs? You talked about your firm doing strategic positioning and so forth, but smaller companies, are there mentors? Are there counseling firms available to much smaller entities than those that you work with?
So there are, and I think Pat hit on this first, kind of, look at your peers as potential mentors. I know there's a program, I believe it's called SCORES, which are some retired executives. I think it's a federal program that is, I think generally free service and targeting largely small businesses. So look to them. But also, again, I think, Pat hit it right on the head. Do a walkabout, look at your peers, your neighbors, and look to them for mentoring, as well as the advisors that I had highlighted in my earlier response.
All right. Here's a question about general question about access to capital for any of you. We read that there's lots of liquidity available. How do small businesses access it?
So again, for small businesses, I think, aside from stuff that Pat's doing and your banks, there are some alternative sources. How to access that? Again, I would turn your commercial banker, probably has some knowledge of referrals that they can give on your behalf for alternative sources or additional capital. And again, your accountants and your attorneys. So at the risk of repeating myself, turn to your circle of advisors, because typically they have a network that they can access on your behalf for that.
Could I ask, Dan, on that, leapfrog on that, is to something what not to do? And I'm sure Heidi has seen this and Ray has seen this. What not to do is to go online and borrow money.
Oh, absolutely.
5%, because you need to get something paid tomorrow.
Right.
And all of us in the financial services serving small businesses have seen good businesses paralyzed by online lending and marginal businesses destroyed. So this is not a time to get as much money as you can get, because from the online space, it's time to operate there very carefully, very cautiously, and seek advice of others before you hit submit on those applications.
And I would agree wholeheartedly with Pat on that, but also don't, even though there is a lot of liquidity, don't borrow money just because it's available, right? You have to have a plan and some reason for what you're looking to accomplish or drive with that money. Because again, if you don't want to be in a situation where you find yourself overly levered and we hit another bump in the road, and now your business is in a crisis in addition to the market being in a crisis.
Yeah. There's a number of questions about interest rates, loan deferrals, and so forth, but let me tee it up by asking Hugh a question. What's the forecast, Hugh, or your forecast on direction of interest rates? Do we still have Hugh?
We do, but I think he's muted, so we might just
Muted,
need to
yes.
unmute him.
Can we unmute him, or should
Yeah.
we?
Hugh, are you there?
Yeah, I'm here.
Great.
Okay.
So question
can-
Hugh on direction of interest rates.
Yeah, you can hear me now?
Yeah.
Okay.
we got you.
Okay, the direction of interest rates is really a question of Federal Reserve policy. Federal Reserve, the question is, will the Federal Reserve change interest rates, which are effectively between 0 and 25 basis points, or as low as they're going to go? First of all, I would add that I don't think the Federal Reserve has an appetite to reduce interest rates further or to negative territory, as other countries have done, and it's been a bad experiment. So the real question is when will the Federal Reserve start to raise interest rates? As I suggested, you're going to see better economic activity. You're not going to see inflation get to levels, in my judgment, in 2020 or 2021 that's going to concern or worry the Federal Reserve. It'll probably be too low, not too high. Economic activity will start to get better. And as we move into 2021, the latter part of 2021, 2022, then you might see the Federal Reserve start to raise interest rates. But between now and then, you're likely to see a very stable interest rate environment. So I wouldn't depend or be counting on or forecasting any change in interest rates before we get to better economic activity. And that's going to have to wait until late 2021. The only other thing I would say, we're not going to get back, I don't believe, until the levels of economic activity, employment, until late 2000, let's call it mid to late 2022. We're going to come back, but we're going to come back very, very slowly. And as I said before, manufacturing first, services second.
All right. So there's a question, Heidi, I don't know if you feel comfortable answering this. It's probably a different part of your bank, but a question on many banks are just deferring payments for up to 3 months on mortgages, at which time the deferred payments balloon. Can't these missed payments be added to the end of the mortgage? The 3-month deferral isn't helpful. Do you have any comments on that, or is that?
Sure. So we, Pioneer, we treat every client differently, right? So there are some clients that would not be the case, and there are other. It depends on the specific circumstance. So it's not that I can comment on that exact. I don't know if that person's bank is necessarily. I'm not sure who that person is or what their banker is, but what we have definitely done is that if people get a PPP loan or have other access to capital, we're saying, it's either deferral or that, because, it doesn't necessarily make sense for someone to have both. But I do know other friends of mine who don't bank at Pioneer that have large real estate endeavors. For instance, their commercial tenants weren't paying rent, so they deferred their payments to their bank, right? So it depends. It's very client specific.
Yeah. There's a couple of questions that are asking for opinion on the timeline for reopening upstate in phase 1. I don't know if anybody, and that I think as I read it is construction and manufacturing, and then maybe some select retail curbside service. Anybody want to venture any guesses on that? There's a number of people curious about that.
The only thing I could say is that I wouldn't be able to guess. Most everybody's obviously watching CDC and what they're telling us to do. But I think that the one thing I would say is I think the governor's got a really sensible plan on doing this. He's, as you know, divided up the state into 10 districts. He's opening up different industries on different time schedules. He's using the Johns Hopkins data on containment for each of the different regions. I think his approach is really sensible, but it's going to be, as you know, Dan, it's going to be staggered. And that's the simple way of saying it. It's going to be staggered by region. It's going to be staggered by industry. And in my judgment, that's a sensible way to do it. So it's really hard to answer that question.
And Hugh, this one is probably best for you too. Opinion on the effects of city, state, and school district budgets.
Obviously, the budgets are going to be under significant pressure. City, state budgets, ask yourself what's going to happen to tax revenues, particularly for the current quarter. Tax revenues are going to get a little bit better as we move through the third quarter and the fourth quarter. I have my fingers crossed on that. But nevertheless, there's going to be a lot of money that's going to have to be borrowed from the federal government, a number of programs promised by the federal government to help cities and states, get through this period of no tax revenues. Again, a very hard question to answer. The tax revenues are going to get better. They're going to get better as we move through 21 and 22, but it's going to be a painfully slow process, and they're going to need to go to the markets to borrow money or go to the federal government to borrow money, all of which is going to be possible as we reopen very slowly.
I think those are all the questions we had. It might be worth turning back to the panel to say, are there any questions you would have asked or any things you think we've missed?
I guess I have one thing, which is a call to our county and state officials. If they want, this is a chance for them too. Rensselaer County, Albany County, Schenectady County, they can decide what their cities and their suburbs become. So I would love to see some direction from them on exactly what businesses they want to see here, right? So I've got a band of 19 lovable, talented misfits that currently work for me in a restaurant that are going to need to work in some other capacity. And I'm totally willing to direct them to do whatever it is that they are capable of doing, right? But I don't think it's going to be operating a full service restaurant. So the things that I'm gravitating towards, and I mentioned this in my earlier comments, they're resources that are backed by the county and state and federal governments. So the Tech Valley Center of Gravity is just right over there. So that's why I picked thinking of that idea, right? Mm-hmm. So I would urge the county officials, especially, and state officials to kind of decide, like, what do you want these downtowns to become?
That's a really good point.
Yeah.
The other thing, Dan, I think that not to be a negative is that if we put too much pressure to open too quickly, mm-hmm. and then we have to close again, many of our small businesses may be able to sustain mm-hmm. 2 or 3 more weeks of inactivity or reduced activity as you wait for just the right time to open. Mm-hmm. But forcing it, at a pace that doesn't make sense, is really something that many businesses could be the death knell to a business that might otherwise survive. And so it's sort of a mixed message there in terms of that. And I think patience and caution is probably well counseled for almost every business in this area.
That's a really good point, because we are thinking of this, we're thinking of the reopening so much in the realm of public health. And of course, that's preeminent. That's what we need to do. But reopening intelligently is also a way to preserve business health as a secondary thing, because if the public health begins to suffer again and we go into another spike, that is going to be even more devastating for businesses that are only then kind of getting back on their feet.
And that's the tricky point, right, Casey? Because where is that balance? We can't know. So it's going to be testing and trying this and a little more testing and trying that. And as we said right up front, there's no playbook, there's no glide path. It's the new frontier for us. So, well, I see it's about 10 o'clock. We're out of questions. I'd love to thank the panelists. I think it was a terrific discussion. I'd like to thank Casey and the Times Union, our partner in this. We're not done. As you know, we have 2 more sessions left. A week from today, which would be May 12th, there's a panel on workforce and human resource issues. And then a week after that, which would be May 19th, there's going to be a panel discussion on a lot of what Heidi was talking about today, which is reinventing, retooling, changing your go-to-market strategies. And again, recognizing that it's going to be different for different businesses, we'll have a number of different panelists on that. We appreciate you joining us this morning. We hope you find these helpful. As you see all over the place today, the phrase seems to be "we're stronger together." And so our view was, if we could all get together and discuss these issues, we could learn from one another. And hopefully we've all walked away today with a couple of ideas. So thanks for everybody's participation. Thanks to the panel. And hopefully we'll see you all next Tuesday.
Thank you.
Thanks a lot.
Okay, bye-bye.